Hi viewers, welcome to the first video of this new year. As you can see, I have a couple of positions open. I sold 4 lots of call and 2 put options. The strike price is 76,200 on the put and 81,000 on the calls. So this is not a trade I entered today. This is my current position. I had entered them earlier in this week. So today is Wednesday, the 1st of January 2025. But I had entered these positions this same week's Monday. Most of them I had entered them on Mondays when the prices were um, something in the 40s or 50s. That is where I entered these positions at that point of time. So let's see how the index has moved, Sensex has moved since then. So that was December the 30th onwards, and if you see, the index was around 78,600, and now it's gone down. It went down all the way to 77,600, 1,000 points below when I had entered, and now it's trading above that at 78,000. So now I'll tell you what was the thought process behind the selection of the strike prices. So if you see, when I entered, I told you the index was around 78,500 or so. Just around this point, I believe. Yes, on the Monday when I entered, and given the Friday expiry, now I'll take you back to the strike prices. Right. So you see, I chose strikes that are at 81,000, which is like 2,400 points on the upper side, and then I also chose 76,200, which is another 2,400 points on the lower side, which is like 3% on either side. I wanted to take strike prices where there's enough premium, which I would encash for a period of the 1 week, and at the same time, the risk is low. So, uh, what you can see here is I've taken a strangle position with different strike prices of the call and the put, which are 6% apart from each others, and some 4.5 days or 4 days remaining till expiry. And because I'm entering on Mondays and Tuesdays, where already there was significant amount of volatility, the premium was also high, and there's a good chance that there'll be a proper decay that is coming in the prices. To track the theta decay over a period of 1 or 2 days immediately after you enter the position, that will give you confidence. That will give you confidence the trade is going the way you want it to be. And what I see is yes, on the call side, there has been a good theta decay. That's because the stock did come down. However, on the put side, you will see there is some negative returns, right? And it's because the stock has moved against the put short position, right? Market has fallen since then. Now I'll take you back to the chart and show you uh, where we are today and what would the expiry ROI profit level look like, right? So let me zoom out to a larger time frame, say 1 hour, and like still cannot find out. And let me go to the daily time frame. Okay, so what I want to do is I want to draw the range over which we need to be profitable. 77, 76,200, 76,200, and 81,000. Okay, yeah, so these are the ranges, and our expiry is this Friday, this coming Friday. Let me draw a vertical line here. Yes. Oops. Okay. There we are. So we're somewhere here at the middle, 78,600 on Monday when we enter the trade. This is where we enter the trade. The crosshair intersection. And this is midpoint between both the upper and the lower strikes in the straddle. The exit is this line. We still have some time to go, and we have come about 1/3 of the distance to the strike price, still within the halfway point, still kind of okay. So even though there has been a move against us, as it stands now, still okay with that, right? Because if we wait for more time, then there's going to be more decay in theta decay in the option premium, and that is going to be the decay is going to be more as we come closer to the expiry date. So today is Wednesday, so entire day you will keep a watch once in a while, and then you also may want to keep a watch on this tomorrow as well, this Thursday, and then see how it is trending. But one caution here, so percentage wise, how much away are we from the current place? Right now the index says 77,900, 1,700 points. It's like about 2.2 2.3% away from the lowest point, with about 2 days remaining till the expiry date. So it's fine, it's okay. If you look at this way, the chance that it will go down by another 2.3 2.4% is less. It is not zero. Again, I'm telling you, I'm not saying it is not at all possible. It may be possible, but the chances are less. How am I saying the chances are less? Just because the movement that we had in the past, of course, there have been days where there have been significant moves, right? Like 1.5% downside, gap down openings. There have been those kind of instances, but they were all triggered due to the most recent one you see here, right? The gap down, and the move that has happened downwards trend has been due to US Fed cut decision, where it was announced that there may not be more than one or two Fed cuts in the next year, while the market was expecting that it would be more. So there was a reaction to that, and you see a multi-day downtrend, and one with a big gap down, followed by a big downside move as well. But since then, for many days, it has been mostly sideward moving sidewards, and that too we are end of the year, right? Christmas and New Year holidays, both the US markets and even in Indian markets, the participation is lower than the average. The volumes in the index and the constituent stocks. So we're not expecting a big move unless there is a very drastic negative update globally, right? Like some new war broke out, so the market can react. But the thing is, like no indication of anything like that way. So it's fair to assume that even if you do have a downside move, it's probably not going to be a very high chance that you will see a down move every single day of 1% or more repeatedly for all the days in the week. That's the reason we enter this trade, the selection of strike prices, and also because if we went further away, we could have. Okay, the question would, could you have gone further away, another 500 points, another 1,000 points away? Well, you could always do it, but then when I calculated the ROI, return on investment, the premiums were quite lower, right? The thing is, up to 3% from the spot price, there's good variation. But if you go, say, another 500 points, you move away from the 3% point, right? Then the premium was like, much lower, right? Just a 500 point move, and the premium would be almost half of this premium which you're getting 3% away, right? So, example, Monday when I wanted to, if I really wanted to enter 81,500, which is like 500 points away from 81,000, the strike price I chose. The premium I got at 80,000, 81,000 was around 40s, mid 40s to high 40s, 50 something, right? If I just move away by 500 points, that will drop to half, right? Below 25, around 20, correct? The thing is, how much risk am I reducing by moving 500 points away when I'm already 2,400 points away, right? So it's like some half a percent or 0.6%, right? So instead of taking a position 3% away, I'll be taking a position 3.6% away, right? So the risk, what are the risk I did have? It's less, already with the 3% strike away, the strike that is 3% away. But on top of it, the premium is decent, right? So return on investment is like what you're getting versus the risk you're taking, right? The return you're getting is getting reduced by half, 50% less, just by moving away some half percent away. You're already at 3% in, 3.6% you're moving, and the premium is reducing by half. So same was the story on the put side as well. At the same time, if you move nearer, the thing is this, right? The opposite move you do. If you want to take 80,500, right? So the premium will be higher at the same time. But then you will instead of being 3% away from the spot price, you will be 2.4% away from the spot price. Well, that will look like not much of a difference. Remember that we are 4 days, 4.5 days away from the actual expiry on Friday evening, and it's not impossible that, because there have been days in the past where in 1 week since the Monday start till the Friday end, there have been moves of 3.5%, 4%, even 4.5%, right? Whenever these big falls have happened, there have been consistent negative days, and on each day there has been a significant down move, right? So there have been weeks where it has reached almost like 4.5% downside also in a weekly move. But again, those weeks coincide with the Fed rate cut discussions or some other war situation globally, and when actual trading volumes were higher before the holidays. So, but right now we are in holiday season, volumes are less. No major events are happening, financial worlds or even the geopolitical situation. We're not expecting, but at the same time, we should not be complacent. Mathematically speaking, what it means is if you go to 2.4% range, right, then your chances of this spot reaching the strike price increase a lot. If you think in terms of averages there, and there's a standard deviation, so much higher chance that now there's much higher chance that the Sensex will actually reach that plus or minus 2.4%, not only expire but reach that point much earlier, forcing me out of the trade, and when I do it with a very big loss as well. There's no hard and fast rule. That's what I want to tell you here. A lot of times it comes down to your perception of the recent trends and the next few days until the expiry, how they are going to be, the big picture. If you get that, you'll be able to see how it is going to work, correct? At the same time, we want to have a proper headway, a proper buffer for yourselves, right? A selecting strike much away from where you think it will. I'm talking about calculated thought. You just see, calculated thought is this, right? You just see how the price has varied over the past few days or the past few weeks, and you see what is the best kind of a move that will come given all of this and given the situations, and you select the trades that way with a proper ROI in mind. Also, it's a balance, right? You're not taking too much of risk to get a lot of premium, at the same time not going away so much further away from the spot price. The result is that it hardly matters that whatever premium you get is very less. So it's a kind of balance, and there's not particular significance why it shows 81,000 and 76,200. It's very specific, right? It could very well be 100 or 200 points on either side. That is still fine. But for me, the way I thought was like Sensex is like 78,000, 79,000, around 80,000, right? So 1% is approximately 800 points. So 3 percentage points is like 2,400 points away. 2,400 is like a big thing, right, compared to the prices that we're entering in the current state. At the same time, there was a good premium I was getting. So I entered in small positions. So that's the reason I chose. But at the same time, I did not enter all my positions in a single shot. So I waited to see how things would evolve. And if you see, I actually have taken 4 lots on the put side and only 2 lots on the call side. That's because I entered on the put side on 2 different occasions. So I'm kind of averaging out here. That's one more thing I wanted to convey you is that when the index did move against the put position, it came down, the market came down. So I entered a few more positions. So that way averaging out cost. And if you just wait over for some time, the spikes would weather out over a period of few hours or few days, and that will give a good theta decay and as well as price movement in your favor. So that's in short the reasoning behind the selection of the strike prices and staggered entry, averaging over a period of time, and at the same time closely watching it, even though I'm confident it will expire within this range. Let's see if I remain completely profitable as per my understanding of the market movement this way. So margin, okay, let me now look into the margin. You say that a total of approximately 3.07 lakhs has been used as margin, and this is for imbalanced straddle, right? Because 2 lots on call side and 4 lots on put side. That's the reason it's higher. However, if at all I had entered 2 more, I had sold 2 more lots on the call side, then I would have had a balanced straddle, and in which case the per lot margin would have been lesser. And the outlook I have is it will still expire within the straddle range strike prices selected, but I'll probably watch the rest of the day today as well. It's not, I don't need to be glued to the screen always. All right, what I can do is I can set alerts for a 500 point move in the Sensex on either side. I can set an alert, that way I'll know that it's moving, which direction it is moving, if the direction move is happening. 500 points corresponds to 0.6% move, right? And maybe once midday, right, around 12:30 p.m. or 1 p.m. I will look into this the market condition at that time and the option prices. Theta decay has happened, then what decay has happened in the premiums by that time. So now we are at the end of the day. Let's see how Sensex index has moved through the day. I'll bring up the 10-minute chart, and just to brief, we entered on Monday around 78, 500, 600 levels, and the lowest it made recently was 77, 500, almost 1000 points below. And today it opened around 78, 200, and it again went down till 77, 900, but we persisted because we saw this up move, and there was no indication on the macro level that it would go even down further, and it paid off. Everything paid off. So it has consistently gone up since then, and it ended the Wednesday today around 78, 600 mark. And let's look how much we made in the portfolio. Oh, here it is. So we're sitting on a decent profit by selling the puts and the calls, this triangle. So here we have not taken new trades today. We just held on to the existing positions and we just track those positions and ensure that the index moves within this triangle range. So we'll continue holding on to this position because current trading price is 25, the premium for the puts. We have 40 of those units are 4 lots. So 40 into 25 is 1000. Another 1000 we will make, and another close to 250 we'll make on the call side as well. So I can see easily, I can see another 1200 rupees coming in if we just stay with this for the next 2 days until expiry, the next Thursday and Friday. This is how the Sensex level looks when compared to our strangle strike prices. On the upper side 81,000, on the lower side 76,200. We still got two more days to go. We're well within the range, 2.5 to 3% away from both the selected strike prices. So there's a very high chance that we will expire within strangle range. So that is how we end today's trading positions.